Hello and welcome to the Morning Filter. I'm Susan Jabinski with Morningstar. Every Monday morning, I talk with Morningstar Research Services Chief U.S. Market Strategist Dave Sequeira about what investors should have on their radars, some new Morningstar research, and a few stock picks or pans for the week ahead. So good morning, Dave. Before we talk about what's on your radar this week, let's unpack last week's market activity. There was a lot of volatility, specifically a lot of intra-week rotation, and then a rally on Friday. So give us a recap and tell us how stocks look today from a valuation perspective.
Hey, good morning, Susan. Definitely a roller coaster of a ride. Last week started off with a sell-off, then we had a brief recovery, another sell-off, and then another pretty strong recovery, on Friday. So the thing is, when I'm looking at what's going on with the market, I would just note that last week, it was really much more of a broad-based sell-off than what we had seen earlier this year. So for the week, growth stocks as a category were down 4.2%. And value stocks, now they still outperform, but they were also down 3.3%, themselves. Now, year to date, value has significantly outperformed. It's up about 0.7%. As growth stocks, are down a lot. They're down almost 10% year to date. From a valuation perspective, although growth stocks have fallen that 10%, we still recommend to investors to be underweight growth and overweight value. From our point of view, value stocks are still much more attractively priced at this point in time.
Now, in last week's episode of the Morning Filter, Dave, you said you were looking for the market to go down another 5% before putting new money into the market. So what do you think after last week's activity?
Well, we certainly got pretty close. By Thursday's close, the market was down, 4.4% on the week. In fact, at that point, it hit official correction territory, meaning that stocks had sold off a total of just over 10% from their recent peak. Just for background, it's a 20% decline from their highs when it's considered, to be a bear market. But then we got that big bounce on Friday. So on a week over week basis, at the end of the week, we're only down about 2.25%. Year to date, the U.S. market, as measured by the Morningstar U.S. Market Index, is down 4.2%. So of course, the question is, was Friday's recovery really a bottom, or is it just a head fake? Is this just a technical bounce, coming off of that correction level, or is this the beginning of a real recovery? So we'll see how stocks, trade in the next couple of days. I think if we were to hold those gains, from Friday, the market's probably going to be okay until we have, earnings start up again, and then we'll see where it goes from there. But to the downside, if the market does turn downward, again, I'm no technical analyst. I don't even pretend to be one, but taking a look at the charts here, it looks like probably the next support area on the S&P 500 is about, that 5,400 kind of area, which would be down another 4% from Friday's close.
Now, we've seen a sizable pullback in AI stocks this year. So give us a little recap of where things stand today.
As painful as the sell-off, might feel, the market really needed it in order to let some steam out of those AI stocks. So what we're seeing this year is the market is really unwinding some of the speculative excesses that we had last year. Of course, if you remember last year, returns were especially concentrated. Over half the total market return in 2024 was driven by just 10 stocks. So when I do an attribution analysis, thus far this year, 7 of those 10 stocks are now down more than the broad market. And when I look at each of those 7, each of those are tied to AI and have been AI plays. And when I look at AI stocks, in general, they're down anywhere from 15 to 20%. Many are firmly into that correction territory. In fact, that's even like bear market territory on those individual stocks. And there's even a couple that are down, even more than that.
So then, given that we've seen AI stocks, at least fall into the correction, if not greater territory, do you think they have more room to fall?
To be perfectly honest, the short answer is, it's impossible to know what the market is going to do, over the next day or two, or even, the next week. But I would say that from a valuation point of view, as a group, I don't think AI stocks have gotten necessarily cheap enough yet in order to bring in value investors. And from a catalyst point of view, it doesn't seem like we really got the capitulation, really got the washout that you would want to see to get rid of all of the speculative excesses that were there. Yet when I take a look at it from a valuation point of view, generally, most of these are now trading, much closer to their fair value. In fact, a few have even fallen enough that they've gone from, overvalued into undervalued territory.
Well, that's a perfect segue into the next question, Dave. Are there any opportunities in that AI stock sector
Yeah.
industry today?
Yeah, there's a few. So the three I'm going to highlight first is going to be Amazon, that's now rated 4 stars and trades at an 18% discount. The next one is ServiceNow. That's actually fallen about 30% from its high. So that's enough to be a 4 star rated stock at a 15% discount. Then lastly is Marvell. Marvell has fallen about 45% from its recent high. That's enough to put it in 4 star territory at a 24% discount. And of course, we still like, both Microsoft and Alphabet, both of those being rated 4 stars.
All right, so let's look ahead on the radar. This week, we have the Fed meeting. Now, we had some good news last week with the CPI and PPI numbers coming in better than expected, but the expectation for this week's meeting is still no rate cut at this week. And what about May?
I think the Fed meeting is going to be just very uneventful. As you mentioned, the market's not expecting, and we're not expecting any kind of cut to the federal funds rate. Having said that, the U.S. economics team is still projecting that next cut will be at the May meeting. They're forecasting a total of 3 cuts, for the year, and then still looking for ongoing rate cuts, into 2026. As you mentioned, both CPI and PPI both came in better than expected. So hopefully this is just the indication that inflation is continuing to moderate here, which of course is the same as our forecast from our economics team. We'll be listening for commentary from Chair Powell. Personally, I don't expect to hear anything particularly interesting from him. I think he's going to get a lot of questions regarding tariffs, and I suspect his answer is going to be as much of a non-answer as he can give, probably just kind of making that typical commentary. Yes, the Fed will monitor the situation as it develops, and if tariffs, impact the economy or inflation, we'll respond accordingly. But I don't think he's going to give any kind of preview into necessarily what they might be thinking.
Well, you brought up tariffs, Dave, so I have to ask you, tariff news will likely continue to be on the radars of investors. Any new thoughts to share on the topic, given that tariffs seem to be driving, or at least that's what the financial media is saying, is driving so much of the market's uncertainty?
Nope. I mean, in my opinion, for now, I still think we're hearing a lot more noise than seeing signal. I think we need to get a lot more additional clarity as to the status of the negotiations and get more specifics as far as what they're actually negotiating. Now, you mentioned how, the mass media out there has really been, harping on tariffs and talking about them a lot. And a lot of articles, really talking about tariffs being, the reason for the sell-off. I would actually highlight an article that John Reckenthaler just published last week on Morningstar.com. Headline is, "Tariffs Aren't the True Cause of the Market's Sell-Off." And the thrust of his articles is really focused on the fact that the sell-off has been concentrated mostly in tech, whereas if the tariffs really were, or the market was going to price in the tariffs leading to a recession, he thinks the sell-off would have been much more broad-based. Actually, I agree with him quite a bit on kind of the main points in his article. I would actually take it one step further and opine that I think it's really been about the market's recalibration of valuations on AI stocks. When I look at AI stocks, they all pretty much peaked, that week. In fact, maybe even that Friday before the weekend, which the DeepSeek, headlines, came out. And AI stocks have been pretty much in a downward trend, ever since then. And according to our valuations, those stocks at that point in time were at best fully valued. And at worst, most of them were getting into, pretty far into overvalued territory. And as we talked earlier, most of those are down, 15 to 20% or more. So yes, getting back to, John's point that this is really much more of a risk-off driven market. But I'd say I think the risk-off catalyst was really driven by kind of that recalibration of expectations in AI.
All right, so on the earnings front, we have General Mills is expected to report this week. So why is this one you're watching?
Well, General Mills stock in and of itself is a 4 star rated stock, trades at a 16% discount, has a 4% dividend yield. It's a company we rate with a narrow economic moat. The stock has a low uncertainty. But I'm looking at it from the perspective of, most of the food manufacturer stocks that we cover are undervalued. Some of them are even more undervalued, than this one. But I'm really trying to listen for any kind of positive commentary we might hear about, the food manufacturers being in a position to start taking, additional pricing. So I think for these kind of companies, for the food manufacturers, we really need to see them starting to bring margins back towards historical norms. I think we need that to happen for these stocks really to start to perform to the upside. But until then, stocks generally are trading at a pretty wide margin of safety from their intrinsic valuation, and they're ones where you just get paid to wait as they all have pretty high dividend yields.
And we also have FedEx reporting in this week. So what's Morningstar think of this stock heading into earnings?
From a point of view of valuation, really it's not very interesting. It's a 3-star rated stock, trades only a little bit under our fair value. But this is one I want to really listen to management commentary. I think from an economic point of view, I think it's going to be very interesting. I just want to hear any commentary they might have about shipping activity, both on a business to business as well as to the consumer. And I think that provides investors a good real-time economic barometer as far as which way the wind might be blowing in the larger economy.
All right, let's move on to some new research from Morningstar. We'll start with a couple of companies that reported earnings last week. Now, Adobe stock was hammered after earnings. It seems like management's outlook for the current quarter disappointed the market. So what was Morningstar's take on the results?
Yeah, we thought earnings were good. In fact, guidance came in line with our expectations. The company reaffirmed its previously issued outlook for fiscal 2025. So our analyst, he said he didn't make any significant changes to his financial model. So we maintained our fair value of $590 per share. So when I look at, the week and kind of how things traded over the week, their earnings came out, I think Thursday morning. And of course, the market got hit really hard on Thursday. So to some degree, maybe it was just a part of the sell-off that, we just had the negative market sentiment overall across all of the market. Now, the stock did rebound a bit on Friday with the rest of the market. So this might be one where it wasn't necessarily idiosyncratic, to the company as much as it just was moving with the broad market.
And then the stock looks attractive from Morningstar's perspective, right?
We think so. It's a 4-star rated stock, 33% discount. Now, it's a company that doesn't pay a dividend, so maybe not necessarily one that dividend investors would have an interest in, but it is a company we rate with a wide economic moat, although as a tech company, it does have a high uncertainty rating.
All right. Well, we also had Dollar General report earnings last week. The stock rallied almost 7%. So what did Morningstar think of that report?
Now, we actually thought this one was kind of mixed. So the results were modestly better than expected. But when we listened to the management outlook for 2025, we thought that outlook was really kind of lukewarm. Overall, I'd say the story here and the investment theme is still the same. So higher sales growth has been coming in the lower margin consumable area. We're seeing lower sales in the high margin discretionary area. So we're getting that negative mix shift. And I think that's exactly what the market has been pricing in. But we think the stock is very undervalued. It provides a lot of upside once consumer spending starts to normalize, once wages catch up to inflation, and you see that spending go back towards those high margin discretionary goods. Overall, it's a 5-star rated stock at about a 30% discount to fair value. Company with a narrow economic moat and a medium uncertainty rating. So looking at the trading action here, hopefully to me, that's a sign that maybe the market is starting to realize that this stock is undervalued. And then lastly, just kind of one other takeaway here, talking to the analyst on this stock, he thinks that as far as tariffs are concerned, when I look at the dollar stores, he thinks that Dollar General would be less impacted than Dollar Tree.
All right. Now, Verizon stock was a pick of yours on last week's episode of The Morning Filter. And the stock took a tumble last week after the company suggested during an investor conference that first quarter competition was more intense than they had expected. So what was Morningstar's take on that news? And is Verizon still a pick?
It is still a pick. It's a 4-star rated stock at an 18% discount. Provides a 6.2% dividend yield. Now, this news was, a bit of a surprise, to me that Verizon noted that the wireless competition, was more aggressive than usual into, the first quarter. I think Verizon specifically noted that their competitors' holiday promotions, extended, into this year, and so they had to respond with their own promotional activity. Even so, both Verizon and AT&T have reiterated, their forecast for the full year despite this tough environment. So I'd recommend to our our viewers here, take a read of the note on Morningstar.com from Mike Hodel. He's the equity analyst that covers the stock. He actually noted a couple things. One, actually he likes seeing this quick competitive response among the wireless competitors. And he thinks that will just kind of reinforce to them the futility of trying to use promotions, to gain share over the longer term. So again, kind of the investment thesis here is that the industry is becoming much more of an oligopoly, that they will compete less on price over time, which will allow margins, to expand. So net, we ended up leaving our fair value unchanged even after that news.
All right, let's take a question from one of our YouTube viewers last week who asked what Morningstar's uncertainty rating is and how investors can use it.
Yeah, so I would think of our uncertainty rating as a way to describe our ability, how much we think we can accurately assign a fair value rating, on a stock. So as you can imagine, some companies are just much harder to forecast, what their future free cash flows are going to be, than others. So one example we use, all the time is going to be a company like Coca-Cola that has a low uncertainty rating. At the end of the day, we're pretty confident we're going to be able to forecast out revenue and earnings pretty close to what the actual results are going to be over the longer term. Whereas you take a company like Tesla that has a very high uncertainty rating, that's just going to be one that's just naturally very hard to predict, the number of EVs that are going to be sold in the future, understand, changes in consumer preferences, understand how the macroeconomic outlook, might change that company's, sales over time. Plus, it also has, a lot of other, emerging product lines, whether that's, full self-driving, insurance, and so forth. So that uncertainty rating at the end of the day is used to drive the ranges that we use above and below our fair value to determine our star ratings. So essentially, it's a way that we try and provide a risk adjustment to our fair value, to take into consideration wanting to have, a greater margin of uncertainty, when the company has, that high uncertainty rating. So that way, you want more margin of a safety to the downside to buy the stock. But then at the same point in time, you'll let that stock run higher to the upside before we recommend selling it. Whereas with those low uncertainty stocks, you don't need necessarily that same range of where the stock is trading compared to our fair value.
All right. Well, we've arrived at the picks portion of this week's program. This week, you've brought us some stocks that are down significantly this year, but that Morningstar thinks are being unfairly punished. And your first pick this week is a stock you alluded to earlier in the program, Marvell Technology. So give us the highlights.
Yeah, so taking a look at the chart here, the stock peaked at $126 a share back on January 23rd. It's now down 45% since then. Looks like it closed on Friday at $68.75. Our fair value is $90 a share, so trades at a 24% discount, puts it in that 4-star territory. It's a company with a narrow economic moat, although high uncertainty being in the technology sector. The moat sources here, there's 2 intangible assets as well as networking just because of their chip design. And we think that moat enables the company to be able to compete at the cutting edge of the semiconductor technology area.
Now, as you pointed out, Marvell is, way off its peak from earlier this year. But fundamentally, Morningstar doesn't think there's been any change to the company's long-term prospects, right?
Yeah, reading through our note here, the last earnings report we actually thought was a little bit better than what we expected. Now, offsetting that guidance was a little bit less than what we had forecasted, but it just wasn't enough to change, our intrinsic valuation. Taking a look at some of the fundamentals here, sales for data center and AI are the primary drivers, of the company. In fact, that's becoming an increasingly, more dominant piece of their business. We still forecast significant sales growth over the next couple of years. In our model, it looks like we're projecting earnings of $3 this fiscal year. So with the stock where it is, that puts it at about 23 times forward PE. And with the amount of growth we're looking for, that PE ratio does quickly step down from there. Looking at earnings next year of about $4 a share, so that'd be 17 times, and then earnings to go to $5 a share thereafter. So again, trading at 14 times that year's earnings as well. So I like seeing that progression of earnings growing and that PE coming down pretty quickly.
Okay, your second pick this week is Wayfair. Run through the numbers.
Five-star rated stock trades at over a 50% discount from our fair value. Now, it is a stock that doesn't pay a dividend. And I'll just note, this is not one of my typical picks. The company does not have an economic moat, does have a very high uncertainty rating on the stock as well. But it just appears to me that this discount to fair value is one of those ones that's, one of the higher ones across our coverage. So I think this is one where that discount to fair value is more than enough to be able to cover for kind of the lack of the moat and that very high uncertainty rating.
Now, Wayfair stock is down about 28% this year. And again, Morningstar's stood firm on its fair value estimate on the stock. So the stock, as you pointed out, looks really undervalued. So give us the story on this one, Dave.
Well, the story too is also going to be, it's going to be a very volatile stock. So I think you have to have it, in that kind of portfolio where you can understand that it can trade around, quite a bit, in the short term. And this may be a stock that it's going to take a while for it really to work, to the upside and start getting anywhere near, our fair value estimate. When I look at this company over the past, 5 years, it's one of those ones that really was significantly impacted by the pandemic. Of course, in 2020, sales skyrocketed. They were up 55%. And of course, that was just because, everyone had to, shop from home as, we had all of the shutdowns. But unfortunately, it's really just been sliding, ever since. Of course, we also had all the shipping bottlenecks and the supply chain, distortions that really impacted their sales as well. When I look at what's going on today, the housing market overall does continue to languish. In our view, we're looking at a slight decline in the top line this year in our model, but we're only looking for 2.5 to 3.5% kind of annualized growth rates thereafter. So really not looking for any kind of big rebound or anything like that. Jamie, who covers the stock for us, she noted they've already cut their expenses, out of their business, really trying to get their business, in line for kind of that current operating area. And in fact, she thinks that would be a lot of fixed cost leverage here. So once that top line starts to grow again, looking for that margin expansion. Now, the other part that's going on here that I think is really impacting the stock will just be what the potential impact of tariffs, could be on the business. So Jamie's noted here that the company really is just an e-commerce site. Really, it's just going to pass through those tariff costs. Essentially, what they're doing is they're just charging a fee, on each of the sales that gets completed, over their website. So what she thinks happens here is that tariffs increase. It's either, one of two things. Either manufacturers will have to accept lower margins, or they're going to raise their prices. So if they raise their prices, consumers, she think, will still stay on the Wayfair site, but they'll just end up purchasing those, same type of items, but from, lower cost or those vendors that are willing to eat, the margin compression. So when I look at the stock, it's only trading at 22 times our EPS forecast this year of $1.43. That drops down to 15.5 times next year's EPS forecast of 205.
All right, your next pick this week is another name we talked about earlier this morning, Adobe. Run through the numbers.
So Adobe's a 4-star rated stock, trading at a 33% discount from our intrinsic valuation. Now, it doesn't pay a dividend, but it is a company we rate with a wide economic moat based on switching costs. And the stock does have a high uncertainty rating because it is in the technology sector.
Now, Adobe stock is down about 28% since mid-December. So talk about how Morningstar's long-term thesis for Adobe differs from that of the market.
Yeah, we think the market is probably pricing in a little bit of our bear case here, which is that, artificial intelligence, could eliminate the need for the creative cloud, over time. We don't think that's true. Specifically, Adobe's new products are gaining traction. Dan Romanoff, who covers the stock for us specifically, has pointed out Adobe Acrobat AI Assistant, Firefly, and Gen Studio. In fact, he thinks, Firefly leaves Adobe pretty well positioned for the growth in AI. And he notes he thinks the company's probably still at pretty early stages of monetization of AI within their businesses. Currently they're generating about $125 million in annual recurring revenue, which, it looks like Adobe expects that to double or at least double by the end of this year.
All right, your next pick is a retail REIT. It's Macerich. Tell us about it.
4-star rated stock, trades at a 28% discount to fair value, 4.1% dividend yield. Now, it is a company we rate with no economic moat, but that's pretty common among the real estate sector, and it's a stock we rate with a high uncertainty.
Now, after a nice run up in the second half of 2024, Macerich is down double digits this year. So why do you like it?
Well, it's actually been a long time since we've talked about Macerich. I look back through the archives here, and we first recommended this stock back on the March 6, 2023 show. Stock's up 56%, plus, the hefty dividends that they pay. And then we re-recommended the stock again back in April 22nd of 2024. Stock's up 20% plus dividends since then. In fact, the stock did hit that 3-star rating territory last December. Now, as you mentioned, the stock has pulled back, year to date, and it does look much more attractive to us, once again. For the people that don't know this name, it is a small cap REIT that invests in Class A shopping malls. The investment thesis here is we still have a positive view on Class A shopping malls overall. These are the malls that have become much more experiential over the last, really last decade. They're much less reliant on retail sales. They've repositioned their portfolios so that they have, many more things that are in the malls that can't be replicated online. So restaurants, gyms, doctor offices, movie theaters, things like that. So that's all helping to continue to keep, foot traffic coming to those malls. So really, this is one where it's just a combination of being able to buy a stock, at what I consider to be a pretty attractive discount to fair value and has an attractive dividend yield.
All right, your final pick this week is PG&E. Give us the key metrics on this pick.
Well, I'll admit probably not necessarily my favorite utility, but I think this pick just highlights just how overvalued most of the rest of the utility sector is today and just how hard it is to find value among utilities. And in fact, you really need to go deep into these story stocks if you want to find undervalued utility stocks today. It's a 4-star rated stock at a 12% discount. Now, it does pay less than a 1% dividend yield. And one of the very few utility stocks we rate with no economic moat, although the stock does have a medium uncertainty.
Well, as you alluded to, the utility sector is outperforming the broad market this year, but PG&E is down about 16% this year. So what's going on?
Yeah, so this is a stock that's not going to be for the faint of heart. So the company is a regulated utility, but it's located in Central and Northern California. So the risk here is going to be wildfire. So I had a pretty lengthy call last week with Travis Miller. He's the equity analyst that covers the company for us. And so what he told me is that California is what's called a strict liability standard for the utilities. So if their equipment are found to have started a fire, they are liable for the damages, even if the utility, wasn't negligent and had taken precautions in order to try and keep, from starting those fires. So what California did a number of years ago is in order to help be able to protect, these companies and really in order to assuage a lot of the concerns of the rating agencies, they created a wildfire fund. So that fund has up to $21 billion of authorized capital. That fund right now is half funded in cash, and the other half is authorized in order to sell bonds, if they need it. So the concern here is that the recent California fires in Southern California, could end up depleting, the amount of that fund. Now, PCG itself doesn't have any exposure or any liability there, but I think the market is very concerned that the liabilities for those fires might be high enough, really to eat up, much, if not all of that 21 billion. So Travis thinks that if those damages really were to deplete that fund, California would probably just expand, the amount of bond authorization in order to be able to replenish the total authorization, of that fund. So essentially, part of the reason he thinks that is that the credit rating agencies were the ones that really required California to create and maintain this fund for them to be able to maintain their investment grade ratings on the California utilities. And without investment grade ratings, it's really hard to run and make a utility, profitable if it's rated below investment grade or junk.
That's an interesting story, Dave. Okay. It sounds like it's a little, yeah, but I can see where it's probably not your favorite utility, as you said, but quite a story. All right. Well, thanks for your time this morning, Dave.
Of course.
Those who'd like more information about any of the stocks Dave talked about today can visit Morningstar.com for more details. We hope you'll join us next week for a special viewer mailbag episode of The Morning Filter on Monday at 9 a.m. Eastern, 8 a.m. Central. In the meantime, please like this episode and subscribe. Have a super week.